Today, we're focusing on planning and variance analysis for both variable and fixed manufacturing overhead. This is a crucial part of managing manufacturing costs effectively. We'll be diving into Chapter 8, which covers flexible budgets, overhead cost variances, and how these concepts help with management control. Understanding these topics will give us the tools to analyze overhead costs more accurately and make informed decisions to keep things on track. Let's explore how flexible budgets adapt to different activity levels and how we can pinpoint where costs deviate from expectations, ultimately improving our management processes. In this section, we'll explore the two main types of overhead costs, variable and fixed overhead. Variable overhead costs fluctuate directly with production activity. This means as the number of machine hours, labor hours, or units produced increases or decreases, these costs go up or down accordingly. Common examples include indirect materials, power consumption, and routine supplies. To manage these, companies often use a flexible rate per unit of activity, allowing for better planning and control. On the other hand, fixed overhead costs remain constant in total within a relevant range, regardless of short-term changes in production volume. These costs include expenses like factory rent, insurance, and salaries for supervisory staff. Since they do not vary with output, they are allocated based on a budgeted rate that considers the company's capacity. Understanding the distinction between variable and fixed overhead is crucial when working with flexible budgets, analyzing overhead cost variances, and ultimately exercising effective management control over production expenses. Let's take a closer look at the distinction between variable and fixed overheads. Variable overhead costs are planned based on an activity base, which means the total cost fluctuates as output changes. The key areas we focus on here are the rate at which these costs occur and how efficiently resources are used. On the other hand, fixed overhead costs are planned for a specific time period, regardless of the level of production. These costs remain stable within a certain range, so the focus is more on how much is spent and the capacity that's being utilized. Understanding these differences is crucial when working with flexible budgets and analyzing overhead cost variances, as it helps management maintain effective control over expenses. On this slide, we're focusing on budgeted variable overhead cost rates. Essentially, this rate is calculated by taking the total budgeted variable overhead and dividing it by the budgeted quantity of the cost allocation base, which often is something like direct labor hours or machine hours. This rate represents the planned overhead cost for each unit of activity. For example, if we budget $120,000 for variable overhead and expect 30,000 machine hours, the budgeted variable overhead rate would be $4 per machine hour. This concept is critical for creating flexible budgets and analyzing overhead cost variances, which in turn support effective management control. Understanding and applying this rate helps ensure accurate budgeting and cost management throughout operations. Here, we're looking at the core formula for calculating the budgeted fixed overhead rate. The formula is simple: you take the total budgeted fixed overhead and divide it by the budgeted quantity of the cost allocation base. Since fixed overhead costs remain constant in total regardless of activity level, the rate itself depends on the planned level of activity. For example, if we have $120,000 in fixed overhead and 30,000 machine hours budgeted, the rate would be $4 per machine hour. This rate is crucial for preparing flexible budgets and analyzing overhead cost variances, which are important for effective management control. Here, we're looking at the structure of variance analysis, specifically focusing on overhead variances. The key idea is breaking down the total overhead variance into 4 distinct components that managers closely examine. These are the variable overhead variance and the fixed overhead variance, which then further divide into spending variance and efficiency variance for variable overhead, and spending variance and production volume variance for fixed overhead. Understanding this framework helps managers pinpoint exactly where deviations from the budget occur. For example, spending variance tells us if the actual costs were higher or lower than expected, while efficiency variance shows how well resources were used during production. Similarly, production volume variance lets managers know whether the fixed overhead was applied efficiently across the actual output. By analyzing these four variances, managers gain valuable insights to control costs effectively and improve operational performance. This four-variance framework is integral to flexible budgeting and overall management control of overhead costs. Now, let's dive into the variable overhead flexible budget variance. This variance measures the difference between the actual variable overhead costs incurred and the variable overhead costs allowed for the actual output. In other words, it compares what we actually spent to what we expected to spend based on the level of activity. The formula is straightforward: actual variable overhead minus the flexible budget variable overhead. This calculation helps us understand if we spent more or less than anticipated for the amount of work done. From a practical standpoint, this variance shows whether our total variable overhead spending was above or below what was expected for the actual activity level. If the variance is unfavorable, it means we overspent relative to the output achieved. On the other hand, a favorable variance indicates we managed to spend less than anticipated. Understanding this variance is crucial for management control, as it highlights areas where overhead costs can be better managed or where efficiencies have been achieved. Now, let's take a closer look at the variable overhead efficiency variance. This variance measures the difference between the actual amount of the allocation base used and the budgeted amount allowed for the actual level of output. Essentially, it tells us if more or less of the cost driver was consumed than expected. We calculate it by taking the actual quantity of the allocation base used minus the budgeted quantity allowed, and then multiplying that difference by the budgeted variable overhead rate per unit. Understanding this variance is important because it reveals whether changes in overhead costs are due to operational efficiency or inefficiency in using resources. This helps management control overhead expenses more effectively by identifying areas where operations may be consuming overhead resources at a different rate than planned. Now, let's focus on variable overhead variance analysis, starting with the variable overhead spending variance. This variance measures how much more or less we paid compared to what we expected for each input hour. It's important to note that this calculation uses actual hours worked rather than the standard hours allowed for production. The formula is straightforward: actual variable overhead minus budgeted variable overhead for the actual hours worked. This variance often reflects changes in costs related to indirect materials, power, supplies, or the rates we pay for support labor. Understanding these variances is key for flexible budgeting, controlling overhead costs, and effective management control. Now, let's talk about the fixed overhead variance. This term refers to the difference between the actual fixed overhead costs incurred during a period and the fixed overhead that was budgeted for the same period. To put it simply, we calculate this variance by subtracting the budgeted fixed overhead from the actual fixed overhead. An important point to remember is that fixed overhead costs don't change with the level of production output. This means the variance we're looking at here isn't influenced by how much we produced, but rather how we managed our spending compared to the budget for that period. Understanding this variance is crucial because it helps us see whether we were able to control our fixed costs effectively. It gives insight specifically into spending versus what we planned, rather than production efficiency. This is where flexible budgets and overhead cost variances come into play, assisting management in control and decision-making processes. Now, let's talk about fixed overhead variances, focusing specifically on the fixed overhead spending variance. This variance is calculated by taking the actual fixed overhead costs incurred and subtracting the budgeted fixed overhead. This difference tells us whether we spent more or less than we planned. If the actual fixed overhead is less than what we budgeted, we call this a favorable variance because it means we saved money. On the other hand, if the actual fixed overhead exceeds the budgeted amount, it's an unfavorable variance, indicating higher costs than expected. Understanding these variances is crucial for managing overhead costs effectively and helps us maintain better control over our budgets through flexible budgeting techniques. It gives us insight into how well we're controlling our fixed overhead expenses relative to our plans. Now, let's dive into fixed overhead variance analysis, focusing on the fixed overhead production volume variance. This variance measures the difference between budgeted fixed overhead allocated and the fixed overhead in the flexible budget based on actual output. Essentially, fixed overhead costs are incurred for a period regardless of production volume, but these costs are allocated through production. When actual output deviates from the planned or denominator level, the allocated fixed overhead will differ from what should have been absorbed given the actual volume produced. This variance is closely linked to capacity utilization. If we produce more or less, the absorption of fixed overhead changes accordingly. Importantly, this variance doesn't indicate a spending issue. Instead, it highlights the difference between the fixed overhead costs incurred and the fixed overhead absorbed, helping us understand how capacity was used compared to what was planned. This insight is valuable for managing budgets and overhead costs effectively. Now, let's talk about how we reconcile actual overhead with allocated overhead. The key idea here is that actual overhead costs don't always match what's been allocated, and we need to bridge that gap using three main variance adjustments. We start with the actual overhead incurred as our starting point. From there, we account for the spending variance, which reflects differences between what we expected to pay and what we actually did in terms of overhead spending. Next, we look at the efficiency variance, which tells us how well resources were used compared to the standard. Finally, we consider the production volume variance, which captures the impact of producing more or less than planned. After making these adjustments, we arrive at the overhead allocated, which is the ending point that ties costs back to production. This process is crucial for understanding where differences arise and managing overhead effectively. Now, let's take a closer look at the four variance analysis approach, which helps us understand and reconcile overhead costs. This approach breaks down overhead variances into four key components that explain the difference between actual overhead and what was allocated. First, there's the variable overhead spending variance. This measures the difference between the actual variable overhead incurred and what the flexible budget allowed for the actual level of input used. Essentially, it tells us if we spent more or less on variable overhead than expected for the amount of activity. Next, we have the variable overhead efficiency variance. This compares the flexible budget allowance based on actual input to the overhead allocated, highlighting how efficiently the inputs were used relative to the budgeted amount. Moving to fixed overhead, we start with the fixed overhead spending variance, which reflects the difference between actual fixed overhead costs and the budgeted fixed overhead. This shows if fixed costs were controlled well or if there were unexpected expenses. Finally, the fixed overhead production volume variance measures the difference between the budgeted fixed overhead and the fixed overhead allocated based on actual production volume. This variance tells us if the production volume was higher or lower than expected, affecting how overhead is absorbed. When we add all these four variances together, the variable overhead spending and efficiency variances plus the fixed overhead spending and production volume variances, we get the total overhead variance. This total tells us whether overhead costs were underallocated or overallocated, and it's a crucial part of managing overhead costs effectively. Understanding these four variances gives us a clearer picture of where overhead costs are deviating and helps management control and adjust operations accordingly. On this slide, we're looking at two key types of variances: sales volume variance and production volume variance. First, sales volume variance measures the difference caused by selling more or fewer units than we originally planned. This variance directly impacts operating income because it reflects how changes in the number of units sold affect revenue and profit. On the other hand, production volume variance relates to the difference caused by producing either more or fewer units than the predetermined denominator level, which is essentially the expected capacity. This variance affects how fixed overhead costs are allocated, depending on the actual capacity used. The main distinction here is that sales volume variance reflects changes in demand, while production volume variance reflects changes in capacity utilization. Understanding both helps us manage and control costs more effectively. Flexible budgets and overhead cost variances tie into this analysis, enabling better management decisions based on how variances arise from sales volumes versus production volumes. Now, let's focus on how activity-based costing, or ABC, changes the way we assign overhead costs. Unlike traditional costing, which uses a single plant-wide rate to allocate overhead, ABC breaks overhead into different activity cost pools and assigns costs based on specific cost drivers for each activity. This approach gives us a more precise understanding of where costs are actually incurred. When it comes to variance analysis, traditional costing compares total overhead using one aggregated allocation base, which can sometimes mask important details. In contrast, ABC computes variances within each activity pool by using its own driver rates. This lets us identify which activities cause variances more accurately, enhancing management control. Overall, ABC provides a more detailed and flexible budgeting and variance analysis framework, helping managers make better decisions by linking overhead costs directly to the activities that drive them. Here, we're looking at how activity-based costing, or ABC, improves the accuracy of overhead analysis by separating it into distinct activity pools. Instead of lumping all overhead into a single plant-wide variance, ABC breaks it down into specific activities like machine setups, material handling, and quality inspections, making the variances more precise and actionable. For machine setups, the cost driver is setup hours, and the spending variance is calculated as the difference between the actual cost at actual hours and the cost at standard rates, resulting here in a $1,200 unfavorable variance. This tells us we spent more than expected on setups. Next, material handling uses move hours as the driver, and we look at efficiency variance by comparing actual quantity at standard rate to standard quantity at standard rate. We see a $900 unfavorable variance here, indicating less efficiency in handling activities than planned. Finally, quality inspections use inspection hours as the driver. The flexible budget variance is the difference between actual overhead and the flexible budget, and in this case, it's $600 favorable, showing cost control in inspection activities. Overall, each activity has its own driver, rate, and variance, which helps managers pinpoint exactly where variances occur and take targeted actions. This approach enhances management control by linking overhead costs closely to the actual activities that cause them. Now, when we move beyond the traditional factory floor, the concept of overhead variances still applies, even in non-manufacturing settings. Think about organizations like hospitals, retailers, or office environments. In these contexts, overhead isn't just production-related costs, it includes support labor, utilities, occupancy expenses, and IT services. These elements collectively form the overhead cost pool. The same logic of analyzing variances holds true here. Flexible budgets are essential because they allow us to distinguish between changes due to cost control efforts and those resulting from variations in activity volume. For example, hospitals compare their actual support costs to the costs allowed based on the actual level of service provided. This comparison helps management identify where costs are being controlled effectively and where they might be exceeding expectations. By using flexible budgets and carefully examining overhead cost variances, managers can maintain better control over indirect costs, ensuring resources are used efficiently regardless of the service environment. This approach integrates well with effective management control systems across various industries, not just manufacturing. In hospitals, overhead variance analysis is used primarily to support cost control rather than to measure factory output, which is quite different from manufacturing settings. When we look at staffing, variable overhead costs tend to fluctuate with factors like patient volume, the mix of cases being treated, and even overtime hours. For utilities, any spikes in usage or changes in rates can create noticeable efficiency and spending variances that need to be monitored carefully. With equipment, fixed overhead costs become important because they reflect budgeting discipline and also highlight the cost associated with unused capacity. Overall, flexible budgets and overhead cost variances are essential tools that help hospital management maintain control over their expenses, ensuring resources are used effectively while adapting to the dynamic demands of healthcare services. When we look at overhead variances in retail, they often reveal how effectively stores turn planned support costs into actual selling activity. For example, store operations like utilities, rent, and equipment directly support the store's daily selling capacity. In staffing, labor efficiency changes depending on factors like customer traffic, employee scheduling, and checkout demand. Inventory handling is another big piece. It involves receiving, stocking, and replenishment, all of which impact how well support costs are managed. Understanding these elements helps us apply flexible budgets and monitor overhead cost variances more effectively, giving management better control over operational performance. Now, let's delve into how variance information plays a crucial role in management control and decision-making. Variance analysis helps transform overhead results into actionable insights across three key areas: spending, efficiency, and capacity decisions. First, in cost control, variance analysis allows managers to pinpoint exactly where overspending is occurring and helps separate the effects of price changes from issues related to usage. This clarity is vital for targeted cost management. Next, operational improvement benefits significantly from efficiency variances. By analyzing these, organizations can identify opportunities to enhance labor utilization, optimize machine use, and streamline process flow, ultimately improving overall productivity. Lastly, capacity planning is informed by reading volume variances, which guides adjustments to output levels, resource allocation, and even future budget planning. This ensures that resources match the operational demands effectively. In summary, flexible budgets combined with overhead cost variances equip management with the insights needed to control costs, improve operations, and plan capacity efficiently. When we look at overhead variances, it's important to understand what they're really telling us. Favorable variances might suggest greater efficiency, but they could also indicate underinvestment. For example, spending less than expected could be due to better prices, tighter control, or more efficient use of resources. However, we need to ask ourselves if this came at a cost. Did quality decline, was maintenance deferred, or did output suffer? Before celebrating a favorable variance as a success, we must confirm that it's sustainable over time. On the other hand, unfavorable variances usually signal higher costs, lower efficiency, or poor capacity utilization. Variable overhead problems often stem from excessive use of activities or increased input prices, while fixed overhead issues might show overspending or production levels falling short of plans. The key question to ask for any variance is whether it's driven by price changes, efficiency shifts, volume differences, or planning assumptions that no longer hold true. Investigation should focus on variances that are significant, recurring, or within the manager's control. We concentrate on large or repeated variances because those are where intervention can make a real difference. Small or one-time variances usually don't justify investing extra time and resources for deep analysis. Ultimately, variances should be used to trigger thoughtful questions and informed action rather than assigning automatic blame. This approach supports better management control and more effective budgeting overall. When we talk about variance analysis, it's important to remember that a variance is really just a signal, it's not a final judgment. One of the biggest pitfalls is when managers jump to conclusions based solely on the numbers, without taking the time to understand what actually caused those variances. For example, misreading a favorable variance as simply good can be risky. Sometimes a favorable variance might stem from poor quality, under-maintenance, or delayed spending, which can create bigger problems down the line. Another common mistake is ignoring the operating context. Changes like volume shifts, mix changes, shutdowns, or learning curves can all distort variances if actual conditions don't match the original plan. It's also easy to get caught up in absolute dollar amounts. Large numbers might seem urgent, but it's more important to consider percentage impact, materiality, and how controllable the variance is when deciding where to focus your efforts. Finally, analyzing variances in isolation can be misleading. Spending, efficiency, and volume effects often interact and offset one another, so looking at a single variance without the bigger picture can lead you to the wrong conclusions. Understanding these common pitfalls helps ensure that variance analysis truly supports effective management and decision-making. When managing overhead variances, it's important to think of variances as a control system rather than just a report. This means making your analysis timely, focused, and directly linked to action. First, setting realistic overhead rates is crucial. These rates should reflect current cost behavior and practical capacity, not outdated assumptions. Next, clearly separate the causes of variances. You should distinguish spending variances from efficiency and volume effects so that managers can address the right issue. Another key point is to review exceptions quickly. Investigate significant variances while the details are still fresh and there's time to correct the problem. Assigning accountability is equally important. Each variance should be linked to the manager or process owner who can influence the underlying cost driver. Finally, make decisions based on trends rather than reacting to every single fluctuation. By comparing results across different periods and activity levels, you avoid overreacting to one unusual month and ensure the response is appropriate. These best practices help create a more effective and responsive overhead variance management system. Let's review the key takeaways from flexible budgeting and overhead variance analysis. First, variable overhead adjusts with changes in activity levels, while fixed overhead remains constant regardless of activity. Next, budgeted rates are essential because they transform overhead plans into practical standards that we can measure against actual performance. When analyzing variable overhead variances, we focus on two components: spending, which shows how well we controlled costs, and efficiency, which reflects how effectively resources were used. For fixed overhead, variances are broken down into spending, showing cost control, and production volume, which highlights the difference between expected and actual production levels. Finally, by conducting a for-variance analysis, we can fully reconcile actual overhead costs with what was allocated, providing a comprehensive view that supports effective management control. These concepts are fundamental to understanding how to manage overhead and improve budgeting accuracy. As we wrap up Chapter 8, remember that mastering flexible budgets and overhead variances is key to improving management control. By moving from simply planning overhead rates to effectively interpreting the results of our variance analysis, we gain sharper insights into performance. This chapter emphasizes budgeting more accurately, analyzing variances thoughtfully, and using that information to manage performance proactively. Make sure to review the reading assignment in Chapter 8 to reinforce these concepts and close the chapter with a strong understanding of overhead planning and control.